Welcome to Tech Money Madness, your daily U.S. stock market podcast. August 12, 2026.
Yeah, and it is quite a day to dive into, that's for sure.
It really is.
Yeah.
So for those of you listening, we're doing a deep dive today into a massive stack of market briefings. And, well, our mission is basically to help you sift through the noise because, the market today is just totally fractured.
Oh, completely fractured. The contradictions are just glaring right now.
Right. Like the big headline you're probably seeing on all the financial screens is that the S&P 500 ended higher today.
Yep, the green arrow.
Yeah, the green arrow. And it was pretty much entirely fueled by AI optimism, specifically following CoreWeave's blockbuster earnings report. But, and this is where it gets weird, we are looking at this market of deep, deep contradictions.
Exactly. You look under the hood, and it's actually deeply unsettling.
Yeah, because on one side you have these incredible technological leaps, massive stock surges.
Just billions of dollars concentrating into very specific pockets.
Right. And then, right next to that, sitting right there on the desk, you have surging national deficits and, frankly, some really bizarre economic anomalies. So let's jump right into the center of it.
The AI boom.
Yeah, the AI boom versus the reality of earnings season.
Right.
Because the market is just ruthlessly picking winners and losers right now. Let's look at CoreWeave.
Oh, CoreWeave was definitely the star of the day today.
Unbelievable numbers. The
Yeah.
briefing shows their Q2 revenue literally doubled. And it's all thanks to hyperscaler AI demand.
Right, which pushed the stock up, 19% in pre-market?
Yeah, 19% jump. And it was one of the most active stocks all day.
Yeah.
Alongside Nebius, actually, which this surged an astonishing 34%.
Which is just a staggering single-day move.
It's wild. But for you, the listener, trying to grasp the scale of what's actually happening mechanically here, what even is a hyperscaler and why are they handing CoreWeave so much money?
So to really understand the money here, you have to understand the plumbing of artificial intelligence.
The plumbing.
Yeah. A hyperscaler is basically a massive cloud computing provider. Think of the companies that literally own the physical servers that, run the modern internet.
Right, the big data centers.
Exactly. And to build and train these new AI models, those companies require just an unfathomable amount of raw computing power.
Just massive energy and processing.
Right. And CoreWeave, they don't build the AI software that you or I interact with. They build and lease out the heavy physical infrastructure.
The hardware.
Yeah, the specialized GPU clusters that you actually need to run it all. So they are essentially selling the pickaxes during the gold rush.
Ah, right. And the market sees that tangible B2B revenue and just pours gasoline on the stock.
Literally.
But wait, let me push back on that for a second. Okay, let's unpack this. If hyperscalers are spending billions upon billions on physical infrastructure right now, isn't there a severe risk that they overbuild?
Oh, the dot-com bubble comparison?
Yeah. We saw this exact same thing happen with fiber optic cables, right? Everyone built the infrastructure for a future that took 10 years to actually arrive.
Yeah, and the stocks just crashed in the meantime.
Exactly. So aren't we doing that again?
Well, that is the exact anxiety lingering beneath the surface today. The bull case, the optimistic view, is that AI compute isn't like fiber optics because it's being immediately consumed.
By who, though?
By enterprise software, medical research, defense algorithms. It's getting used right now.
Okay, fair enough.
But the bear case, the one you just mentioned, is that we are front-loading a decade of capital expenditure into an 18-month window.
Wow.
And if that enterprise demand falters even slightly, those infrastructure companies are going to be left holding empty, incredibly expensive server farms.
Which is a terrifying thought.
Oh.
And that actually brings me to the losers today. Because this is where I am genuinely struggling to square the logic.
Yeah, the punishment today was brutal.
Cerebras Systems and Cisco. Let's look at Cerebras. According to the briefing, they actually reported better than expected second quarter revenue.
Mm-hmm.
They even raised their full-year guidance. They literally told the market, hey, we are going to make more money than we originally promised you.
And the market said, we don't care.
Right. The stock plunged 14%. It's like a student getting an A+ on a test, promising to get an A+ on the next one, and still getting grounded by their parents.
That's a great way to put it.
Why is the market punishing a company that just beat its own numbers? And Cisco, too, they topped quarterly estimates and their stock dropped anyway.
Well, what's fascinating here is that the market isn't grading them on today's test.
What do you mean?
They're grading them on a hypothetical final exam, 3 years from now. AI has introduced this phenomenon that we call timeline compression.
Timeline compression. Okay, explain that.
So investors are no longer valuing these companies based on their trailing earnings or even what they'll do in the next 12 months.
Right.
They are pricing in absolute exponential perfection, stretching all the way out to 2030.
So it's like the market isn't buying the company's current reality. They're basically buying a time machine.
Exactly. A very expensive time machine.
So if Cisco's time machine is only set to deliver, steady profits next year, but CoreWeave's is set to deliver a global monopoly in 2035, the money just abandons Cisco instantly. Even if Cisco is making billions today.
That is the perfect way to visualize it. With a stock like Cerebras, investors are modeling this hyper-growth curve.
Right.
So if the company beats revenue, but their profit margins compress by 0.5%, or if their forward guidance suggests the growth angle is flattening even slightly.
That futuristic 2030 valuation just completely collapses.
Yep. The market is demanding a flawless trajectory right now. So better than expected by traditional standards is fundamentally viewed as a failure in a sector that's basically priced for miracles.
Man, I want you, the listener, to think about your own portfolio for a second. Think about how you evaluate good news in an environment where simply beating estimates gets you a double-digit stock plunge. It breaks value investing completely.
It really does. And if we connect this to the bigger picture, this brutal capital rotation, it isn't just staying confined to enterprise servers.
But it's bleeding into everything. The whole tech battlefield is evolving. I mean, we're going from pockets to literal orbit.
The concept of a unified big tech monopoly is actively fracturing right in front of us.
Yeah, Google is a prime example in the briefings today. They are launching the Pixel 11 lineup. And for years, smartphone releases were basically just companies arguing over like battery life and
Megapixels.
right camera megapixels.
Yep.
But the briefing states that Google is explicitly centering this launch entirely around Gemini, their flagship AI.
Putting the AI arms race directly into your pocket.
Exactly, taking the fight straight to Apple.
Well, and they have to, right? Because the physical hardware has become completely commoditized.
Yeah, a phone is a phone these days.
Right. A smartphone from 3 years ago takes a picture that is virtually indistinguishable to the human eye from one released today.
That's true.
Google realizes that the only way to maintain ecosystem lock-in, to keep you from just jumping over to an iPhone, is to integrate an AI assistant so deeply into your daily workflow.
Like your emails, your scheduling.
Yeah, exactly. Yeah. So deeply that leaving their hardware ecosystem becomes too painful. They are shifting the battlefield from hardware specs to behavioral reliance.
That's so interesting. But here's where it gets really interesting. While Google is attacking, another legacy titan seems to be just totally stuck.
Amazon.
Yeah, Amazon. They were one of the day's most active stocks, but the briefing notes the stock is completely stuck in a rut. In fact, trader Mike Cow is publicly betting it's going to stay that way.
Which is saying something.
Right, because Amazon has its own massive cloud infrastructure. Why are they treading water while everyone else is rallying?
It comes down to their exposure to the everyday consumer.
Oh, the retail side.
Yeah. Amazon Web Services is obviously a cloud behemoth, but their core identity is still deeply tethered to e-commerce. And e-commerce is a mature, weary market right now.
Yeah, people aren't buying as much random stuff.
Investors are looking at Amazon's massive logistics network, and they're seeing a ceiling on growth, especially when the consumer buying those cardboard boxes is feeling strapped for cash.
So capital is rotating out.
Exactly. It abandons stagnant outlooks and floods into frontier tech.
And speaking of frontier tech, we have to talk about SpaceX, because this blew my mind today. SpaceX saw a massive movement, rebounding more than 40% off its low.
An incredible swing.
Yeah, and the briefing specifically mentions that short interest fell to about 11% of its publicly traded shares. Now, I know short selling is a bet against a company, but does people simply changing their minds cause a 40% surge in one day?
No. You aren't looking at organic enthusiasm there. You are looking at the mechanics of a trap-snapping shut. It's a short squeeze. When an investor shorts a stock, they don't just magically place a bet against it. They are literally borrowing shares from a broker, selling them into the market at today's price, and hoping the stock drops.
Right, so they sell high and plan to buy low later.
Exactly. Return the borrowed shares, keep the difference. But what happens if the stock goes up instead?
I assume they lose money.
They start bleeding cash fast. Because the stock can only drop to zero, but mathematically, its price can rise infinitely.
Oh, wow. So their potential losses are limitless.
Limitless. So as positive sentiment returns to SpaceX and the price starts ticking upward, these short sellers panic.
They have to get out.
Yes. To stop their losses, they are forced to buy shares at the current higher price just to close out their original borrow.
Ah, so you have millions of people who essentially hate the stock, suddenly forced to buy it all at the exact same time.
Precisely. And that forced to buying pushes the price even higher, which triggers the next wave of short sellers to panic and buy.
Which pushes the price higher again.
Right. It acts like mechanical rocket fuel. The 40% surge is just the mathematical unwinding of a failed bet.
That is fascinating. But, we're talking about stock mechanics, time machines, AI optimism. Let's bring this back down to earth for a second.
Let's do it.
Because the macroeconomic data in today's briefing, it's acting like a massive gravitational pull, just dragging behind this high-flying tech market. We've got to talk about the deficit.
Yeah, the national debt numbers are staggering today.
The U.S. budget deficit surged in July to its highest level since March 2021. And listen to this. The collective red ink over just the first 10 months of the fiscal year is now nearly $1.8 trillion.
That number should stop every investor in their tracks. I mean, we are running a wartime crisis-level deficit during a period of peacetime economic expansion.
I want to push back on that panic for a second because, look, we hear politicians complain about the deficit every single year. The number always goes up. Yet the S&P 500 is sitting near all-time highs. Unemployment is relatively stable. Does a $1.8 trillion deficit actually matter to the reality of the market, or is it just a scary headline?
Oh, it matters immensely. And it's because of the mechanics of how that debt is serviced.
Serviced?
Yeah.
Like paying the interest?
Yes. It isn't just a number on a ledger. The government has to issue treasury bonds to borrow that money. And right now, interest rates are significantly higher than they were 5 years ago.
Right.
So a massive growing portion of that 1.8 trillion isn't going toward, infrastructure or the military or healthcare. It is literally just paying the interest on the old debt.
Oh, wow. It's like a household maxing out a new credit card just to make the minimum monthly payment on their old credit cards.
That is exactly the right mechanic. And when the government floods the market with treasury bonds to fund this, they soak up capital that could have been invested in the private sector.
Oh, I see.
Furthermore, this massive government spending acts as a shadow stimulus. It is artificially holding up the GDP numbers.
The tech market looks weightless right now, but it is standing on an economic foundation that is heavily subsidized by borrowed money.
And while the government borrows trillions, the actual consumer is living in a completely different, highly constrained reality.
Oh, absolutely.
Let's look at the housing market data today. Mortgage rates have finally stopped rising, which sounds like good news. And the briefing notes that demand is starting to trickle back in. But why is it just a trickle? If rates stop going up, shouldn't buyers just flood back into the market?
Because we are dealing with the lock-in effect.
The lock-in effect.
Yeah. For the better part of a decade, consumers locked in 30-year mortgages at historically anomalous rates, around 3% or even lower.
Right, the golden handcuffs.
Exactly.
Yeah.
So today, even if rates pause their climb, they're still hovering around 6 or 7%.
If a family wants to sell their starter home and upgrade, they aren't just taking on a higher purchase price for the new house, they're literally doubling their cost of borrowing.
So the interest payment alone prices them out of moving.
So they just don't move. The inventory stays completely frozen. The trickle of demand we are seeing is largely forced life events. People who have to move for a new job or a divorce.
Right, not by choice.
Yeah. The structural affordability of the housing market is basically broken for the median earner.
And the absurdity of this macroeconomy, it doesn't stop there. Because amidst trillion-dollar deficits in frozen housing markets, the briefing gives us this bizarre detail today.
Oh, the lettuce.
The lettuce, the price of lettuce, just posted its sharpest month-over-month decline on record.
A sudden deflationary shock, but not for a good economic reason.
No, not at all. It's due to a cyclospora outbreak.
Right.
So we've got an economy with $1.8 trillion in government red ink. Families can't afford to move. But hey, at least lettuce is historically cheap because it might make you sick and put you in the hospital.
It's unbelievable.
It feels like the economy is a leaky boat.
Yeah.
But we're getting a discount at the buffet. The contrast is just comical.
This raises an important question regarding economic uncertainty.
Right.
How can a market sustain AI-driven highs when the foundational economic backdrop involves massive deficit spending and a frozen housing market.
It's a huge disconnect.
The trickling demand in mortgages shows consumers are highly sensitive to rate changes, standing in stark contrast to the billions flowing freely into tech.
Yeah, and these macro pressures and consumer sensitivities aren't just domestic issues. When we look at global sector trends in today's briefing, we are seeing massive industrial shifts.
Huge shifts, directly challenging Western dominance.
Let's start with aviation. COMAC, which is China's homegrown aerospace manufacturer, made its first scheduled international commercial flight today.
Which is a huge milestone.
Yeah, and we see new tech companies pop up all the time, right? But why is a new airplane manufacturer such a geopolitical earthquake?
Because commercial aerospace is arguably the most complex and heavily fortified manufacturing sector on the planet.
It's hard to build a plane.
Very. The barrier to entry isn't just money. It's a decade of research, astronomical regulatory hurdles, and building a flawless supply chain involving, like, millions of parts.
Wow.
Because it is so difficult, the global aviation industry has operated as a heavily protected duopoly for decades.
Right, you either buy a Boeing from the United States or an Airbus from Europe. There was basically no third option.
Until now, COMAC entering the international scheduled flight arena is a direct, tangible swing at that Western duopoly.
Especially with Boeing struggling lately.
Exactly. Boeing has spent the last few years stumbling through severe manufacturing crises and safety scandals. They left the door cracked open.
And China just walked right through it.
Yep. With heavy state backing, this isn't just a new plane. It represents a fundamental shift in global industrial power.
And that industrial shift is happening on the ground in China, too. We got the China Passenger Car Association data today showing that new energy vehicle, or NEV, penetration rose again in July. Interestingly, though, the briefing points out that Tesla's Model Y remains highly popular over there. With so many cheap domestic EVs in China, how is Tesla holding its ground?
Well, it's a brutal price war, but Tesla has spent years aggressively localizing their supply chain in Shanghai.
So they aren't importing the cars.
Right. They aren't exporting expensive cars from the U.S. to China. They are building them right there, which allows them to slash prices and compete directly with domestic giants like BYD.
Okay, that makes sense.
Maintaining that market share is a massive victory for them because China is the proving ground. If you can survive the price war in China, you can survive anywhere.
Wow. So we have these grand global industrial battles playing out in aerospace and electric vehicles. But then let's look at what is happening with legacy businesses right here at home.
This is a fun one.
Wendy's. Wendy's stock jumped today following a report of a potential takeover bid from Nelson Peltz's Trian Fund Management.
A classic activist investor move.
Right. So for the listener who hears that term thrown around, what does an activist investor actually do to a fast food chain? Like, what does this all mean?
So an activist investor doesn't just buy a stock and wait for it to go up.
Okay.
They use massive pools of capital to buy a significant percentage of a company's voting shares. Once they have that leverage, they force their way onto the board of directors and demand radical operational changes.
Basically to squeeze cash out of the business.
Exactly. They aren't there to invent a better chicken nugget.
Right.
Not at all. They are looking at the balance sheet. They might force Wendy's to spin off the real estate they own, or cut corporate overhead, or buy back shares just to artificially boost the stock price.
It's all financial engineering.
Yeah. While the tech world is focused on building futuristic AI models, the private equity world is looking at mature, stagnant businesses and trying to wring out every last drop of efficiency.
Which actually brings us to the most fascinating consumer paradox of this entire deep dive.
The eclipse.
Yes. We just talked about activist investors having to squeeze pennies out of fast food chains because everyday retail is struggling. And yet, the briefing notes that demand for the upcoming solar eclipse has pushed hotel prices in Europe to over $1,000 a night.
It's wild.
I'm having a hard time connecting these dots. Are consumers completely broke, or do they just have thousands of dollars laying around for a 3-minute astronomy event?
You've just identified the defining characteristic of the modern economy.
Which is?
The bifurcated consumer. Consumer behavior is completely fractured right now.
How did that work in practice? I mean, it's the same people, right?
Yeah, it means the same person is behaving like two different demographic groups simultaneously.
Okay.
Faced with the $1.8 trillion macro-level debt, the crushing mortgage rates, and the general economic anxiety we discussed, consumers are aggressively trading down on daily necessities.
Right. Skipping the fast food combo meal, buying generic groceries, delaying a car purchase.
They are acting like they are in a deep recession on a Tuesday.
But on Friday,
Exactly. On Friday, they will violently protect their spending on a unique, unrepeatable experience.
like an eclipse.
Yeah. The psychology has shifted. If the macroeconomy dictates that you will never be able to afford the traditional American dream of a 4-bedroom house because interest rates are locked at 7%, you stop saving for the house.
You just give up on the asset.
Right. You take that capital and you redirect it toward hyper-optimizing for personal joy in the present moment.
So they won't buy a starter home, but they will absolutely drop $1,000 to watch the moon block the sun from a European balcony.
Yeah.
They aren't buying assets, they are buying memories.
It is a completely different value system, and it
Yeah.
explains why consumer data looks so contradictory to economists who are, still using models from 20 years ago.
We have covered an incredible amount of ground today, pulling apart this fractured reality. I mean, we started with the sheer mechanics of the AI boom, CoreWeave, and DBS dominating the AI optimism narrative, right?
Supplying the physical infrastructure for hyperscalers.
Yeah. And the market punishing companies like Cerebras and Cisco because of timeline compression, demanding a flawless path to a futuristic monopoly.
And we saw how capital rotation fuels extreme stock movements, too. From the short sellers getting totally squeezed out of their SpaceX bets to Google desperately trying to lock consumers into an AI ecosystem as smartphone hardware commoditizes.
Right. And then we dug into the structural pressures weighing down the economy. A $1.8 trillion government deficit acting as a shadow stimulus. A housing market frozen by the lock-in effect of old mortgage rates.
Plus the global chessboard shifting. Comac finally breaking the Western aviation duopoly, and Tesla fighting a brutal price war in China.
And finally, we saw the rise of the bifurcated consumer, trading down on daily calories at Wendy's while paying astronomical premiums for solar eclipse experiences. It is just a massive puzzle to piece together.
It really is.
But as always, we want to leave you, our listener, with a final thought to mull over.
Yeah. Given everything we've unpacked today, how the market demands absolute future perfection from AI companies, how short sellers are squeezed by momentum, and how the actual economy is being held together by deficit spending and highly selective consumer splurges.
It forces a critical question.
It does. When you look at where money is flowing today, are we actually investing in companies based on what they produce in reality? Or are we collectively treating the stock market like a financial time machine, trying to purchase a speculative dream of a future that hasn't even been built yet?
And if that future arrives slightly behind schedule, what happens to all the capital currently floating in the air?
Exactly.
It's a question that cuts right to the heart of the split-screen market we're all trying to navigate, which reality is actually sustainable. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.